There are about 10 minutes remaining until today's closing bell. Helping us to really break down today's market moves, we've got our own Julie Hyman and Adam Johnson in the newsroom. Trader Levin of Trading Advantage standing by the Chicago Mercantile Exchange. Also with us on this Thursday, Hugh Johnson, the chairman of Johnson Illington. And Hugh, let's kick things off with you. So the Fed chairman saying we can keep rates longer for some time. Do you think that's the right course of action in your view?
I'm not sure there's anything he could say but that. I don't think it's necessarily the right course, but right now, when you take a look at the state of the economy, you know, there's some weakness in the economy. You take a look at housing, for example, that's weakened. You take a look at bank lending and monetary growth. That's not what it should be. So I think his statement, at least for psychological reasons, to keep rates at an extraordinarily low level for an extraordinarily long period of time is probably the only thing he could say, at least now. That may change in 2 months.
But Hugh, he not only said, I understand your point that this is all he can say, but he said the U.S. economy still needs low interest rates. I mean, do you agree with him, or do you think we're strong enough, we're seeing the signs that we're strong enough to start changing that policy?
No, it's not strong enough yet. If you take a look at some of the more recent numbers, if we look at growth in the first quarter, for example, I think growth is going to come in at somewhere between, say, 2 and 2.2%, which is, yeah, that's fine, but it's not 3%. It's not really strong enough. In other words, I think really the bottom line is he's saying, and I agree with him, that the recovery is not on firm enough footing now to start to raise short-term interest rates. And then he's also saying, which is important, is that he doesn't see any signs of upward pressure on prices. So there's not a lot of reason to raise interest rates. I don't agree with him on that latter part, but nevertheless, that's what he says.
Let me go down to Larry Levin right now at Trading Advantage, standing by the Chicago Mercantile Exchange. I just noticed, Carol pointed out to me, to be honest, here that we turned negative on the S&P 500 from such a strong rally today. Larry, what's weighing on us in the latter half of the day?
I think just a little bit of profit taking, Matt. I'll be honest with you. This market's done nothing but trend higher for God knows how long. And I don't think that's going to stop anytime soon. But the profit taking, and for instance, you mentioned the stock indexes coming off their highs. The S&Ps was just about maybe a point, maybe 2 points lower, and they came off of being up 10 points on the day. So this shows you, how much we had to come back just to get down 2 points on the day. And that shows you really the strength in this market. Again, I don't think it's going to stop anytime soon. And
you don't think there's any concern about sovereign debt? I mean, we're hearing so much coming out of Europe today. It's not a concern for you?
It is a concern. A lot of the things that Hugh mentioned are concerns also. The housing, the amount of credit that's being offered out there. Those are all concerns, but the market doesn't seem to be paying any attention to those things at all. I think it should be. Most traders, professional traders down here, think it should be, but it hasn't in 18 months. I don't think it's going to, like I said, I don't think it's going to start paying attention today or tomorrow.
Hugh, you still say we are in the early stages of a stock market economic interest rate cycle. I mean, you still see more gains to come, correct?
Yeah, no question about it. I mean, when you take a look at history, the average duration of these cycles is 43.4 months. We're currently at the 12-month mark, and so it's pretty early, just based on that simple observation. Too early to be saying that we're at the end of this cycle.
Hey, Adam, another from one Johnson to another. Hey, question for you. A bad auction yesterday, a kind of lousy auction today. Is that any reason for equity investors to be concerned?
Well, you're always concerned when interest rates start to edge up, and you certainly saw that on the 10-year. But I think it's important just to note that at this stage, and again, I emphasize early stage of a cycle, it's not at all unusual for the stock market to be going up and interest rates to be going up at the same time. Basically, interest rates have not gone up enough or not at a level which is going to kill off the current economic recovery and bull market. So it's not at all unusual. It just means, and this is important, it just means the gains in the second year, the current year, are not going to be as exciting or as they were in the first year, the March to, say, December time period. They're just making money in the market's going to become more difficult because of a rising interest rate environment in 2010.
Hugh, you know what? While we're on the subject of sectors that have done well and sectors that haven't done well, but everyone thought they should or thinks they should, what do you think we should look at right now, since you think we're in the middle of a bull market that should go much longer?
Well, the sectors that have performed well, that should perform well at this stage, would include consumer cyclicals, industrials, and, as you mentioned, technology. A couple of sectors which ordinarily perform Well, in a bear market, not a bull market, would include healthcare and consumer staples or non-cyclicals, and they're performing well more recently. What that simply tells you is we've got some bull market sectors performing well, and that's fine, that's normal, but we also have a little bit of defensiveness starting to creep into this market. The reason the defensiveness is creeping into the market is, as I mentioned before, and as Chairman Bernanke said, you know, this economy and earnings outlook is, you know, it's okay, it's positive, but it's not particularly scintillating, or it's not on firm footing. And I think that's the reason why you see some investors being a little bit careful at this juncture, or a little defensiveness starting to creep in.
You know, Larry, something that's caught my attention here, I'm looking at the VIX. Right now we're up about 3% on the VIX. We were down 5%. You know, earlier when we saw some gains in stocks, we were up 7% on the VIX yesterday. Volatility, everybody at the end of last year said expect a lot of volatility this year, and that's kind of what we're seeing to some extent.
A little bit. It's starting to pick up a little bit right now, Carol, but I would say that it's still on the lowest end. I mean, if you go back to 2008, we saw the VIX trade above 50 and 60. Now it's trading well below 20, maybe getting close to 20, but still not the action that active traders want down here. But it is a little something. In the last couple of days, we've seen, like you said, the VIX tick up a little bit. That's good for traders down here on a day when we're sitting on the lows in the stock indexes. It's to be expected that the VIX is picking up. An inflow of orders are coming in. That's what the VIX measures. So that's what we're seeing today. But I'd like to see a lot more. I want to see a lot more action, and we want to see the markets move to both sides, just not up.
Right. You guys love when the market moves around.
I want to downplay how well tech did last year. You look at the 60% gains from 2009, but this year it's been kind of a laggard. Why, when all of a sudden it seems everybody's behind it, does it do so much more poorly, or not as well, I should say, as the rest of the market?
Well, I think if take a look at the durable goods numbers. Now, I don't like to get technical, but if you looked at the durable good numbers that came out for the month of February, and they came out just a day ago, if you look within those numbers, you see some troubling signs. We've had spending on equipment and software, which is going to drive the technology sector, has been very strong. But those numbers were weak. And that's why I think technology is starting to weaken up. There's starting to be some second guesses on how strong the spending, capital spending in general, but more importantly, spending on equipment and software is going to be going forward. Technology, as a result, has weakened up. And, you know, you would expect that. It's had a big run. There are concerns about valuation. It's got to have good earnings in order to drive it further. And there are now questions as to whether you're going to get those earnings if spending is starting to slow a little bit.
But, Hugh, let me just ask you really quickly, though. You're still overweight, though, in technology.
Yeah, I am, because, you know, the relative performance, the way I look at it, is still fine. I know it's broken down on a short-term basis. I know that it's been a laggard more recently. I know that I'm being very tested on it, and I am being tested on it. But my numbers say stay overweighted for the time being. But believe me, I'm very troubled about it.
We got Larry Levin of Trading Advantage out in Chicago, Hugh Johnson of Johnson Illington. Hey, Hugh, let me kick things off with you. You were just talking about technology. You like it, but there are some concerns out there. Here are the numbers from Oracle and some comments from Larry Ellison. What are your thoughts here, hearing what he had to say in their results?
Well, let me add that I own it personally, and I own it in all my client portfolios. I listened to the numbers, I listened to your analysis, and I think you're probably pretty close to right. I like those revenue numbers. As you know, the street is now focused not just on earnings, not just on margins. Adam was quite right in talking about the problem in these numbers, which is the margin number. But it's very encouraging to see that revenue number, and it's very encouraging to see what Ellison has to say going forward. They're going to continue to grow, or things with the integration of Sun is going to start to, let's say, hit its stride in the second quarter, and you'll see that show up in financials. So I was pretty pleased with what you told me about it, but again, I'll have to take a closer look at the report. So basically, okay.
All right, let me get back over to Larry real quickly. Just about 30 seconds left here, Larry, and ask you about something completely different, because we've been focusing on tech so much, but the technicals of the market. You talked a little bit with Carol about the VIX. What about volume? I mean, you want to see volatility pick up. Are you going to see that? You want to see volume pick up, I'm sure, as well.
Yeah, I do, but I don't think it's going to happen anytime soon. This whole rally's been on low volume. In fact, if you ask me, about 40 to 50% of the people who invest in the futures markets and the stock market in general are just not here anymore. They're out of money. They're not trading. It's starting to get a little bit better, but certainly the volume that we saw a couple years ago is just not here, and I really don't think it's going to come back, unfortunately, anytime soon. The economy has to improve, not just the stock market. That'll bring the volume back.
All right, hey, Larry, thanks so much for joining us. Larry Levin there at Trading Advantage. And Hugh Johnson joining us from Johnson Illington. We can never have enough Johnsons, apparently, in the close.